Move slow when you're trying to make money. Move fast when you're trying to preserve it or protect it. If you watch something pan out that you have done analysis on and you've been successful with it, don't be in a rush to get another dopamine hit because that feels good. That's a neophyte, that's a brand new trader's trap. When you're journaling, you're not recording your negative results in a manner that is condemning. You don't use language or terms like, oh, I was stupid, or this stuff is never going to work for me. Never, ever, ever in your journal, ever record anything negative. You can still highlight the fact that you did something incorrect, but how you describe it, how you encapsulate that in your journal, your subconscious is going to remember that. From a higher time frame, I do this, and I look at where price is likely to go. It's only going to go up for one of two reasons. Okay, price delivery continuum is the movement from where price is right now to future delivery. So where it's going to be 5 minutes from now, a week from now, 2 days from now, 2 sessions from now. It's going up to take out buy stops, or it's going up to trade into some kind of inefficiency, like a fair value gap. That is it. That's the only two reasons why price goes up. First thing I'm looking for is inefficiencies, because that's the array that the algorithm reaches for first. If there's no inefficiency and we're in a premium and we're likely to go lower, then it's going to be looking for sell side. Reverse that. If we are in a range and we're in a discount and there is no inefficiency above price, but there's a short-term high, it's going to run for the buy side. You don't need the same entries. The entries are the least important thing. I'm going to say it again. Where you enter is the least important factor in consistency. It is the least important thing. You have to know, where is it going? How we know if it's going to continue going lower is how we close after hitting mean threshold. That's part of order block theory. If it closes below the mean threshold, chances are we're likely to see it want to continue going lower. Inside this window of time is when the trade begins, when the shift in market structure will occur, when the high of the day forms. We want to see, does it reject after bumping the high here? Yes. Once it leaves that shaded area, how did it leave it? Energetically? Yes. Is price returning back up to that shaded area? Yes. Where specifically? The low end of it. It doesn't need to go back up to consequent encroachment. You would have taken partials, and it wouldn't have mattered if it went down here. So that's how your analysis needs to make room for you to be wrong, but not unprofitable. You're always looking for a way to take something out, but that has to be predetermined. Why am I not using this down close candle and this down close candle, ICT? It's inside the shaded area, right? Of the gap. We have to use outside of the range. I treat every one of these tails and wicks, I treat them the same way as I do with a gap. Okay? The algorithm refers to that area as a inefficiency or a gap, so it's treated the same way. Midpoint is consequent encroachment, and if we are looking at this wick here or tail, the low for maintaining bullishness would be consequent encroachment, which it's happening every time I tell you there's a balanced price range. This is what's occurring. The market's returning back to equilibrium. That's what this is here. Okay, it's not consequent encroachment. It's not mean threshold. It's equilibrium. A balanced price range is going to go back to equilibrium. The bodies in here are supporting that. As long as we don't get any close lower, there is no manual intervention. If it does, there's manual intervention and you abort it. You asked me to tell you how I know certain fair value gaps are going to stay open, and I'm not hiding it from you. I'm telling you, this is it. This is what I'm doing to do that. I don't feel those problems or fear because I'm trusting that the order flow is being supported by every candlestick. That's real order flow. All the candles are supporting each other. There's no trend line required. There's no moving average required. There's no VWAP required. Nothing. It's pure price. Just pure price. At 10 o'clock, we have 30 minutes behind us, which is why I tell you the 30-minute opening range. That's important. Every algorithm uses that first 30 minutes. They use that to refine a very specific range to look for inefficiencies and allow sometimes liquidity to form below or above it, and they'll do another pass. Whenever there's an FOMC event, it's to be treated in 2 stages. This is going to be a general rule of thumb. It will serve you more times than not. You will lose money on it eventually if you push it every single time. I promise you that. You have to know which of the indices that you're going to trade because of relative strength. Which one's stronger? There's always going to be a leadership issue, whether it be NASDAQ or ES, Dow. Okay. If it's Dow, I just go to ES. If it's NASDAQ, I will trade NASDAQ over ES.